Ladies and gentlemen, welcome back to another episode of Investing for the Common Man. My name is Luke, and I'm here to help you save not only your money, but more importantly, your time. Decades ago, before electronic trading, the only way to trade stocks was person to person. You may have seen pictures or clips of the utter chaos of trading pits. Unless you happen to be in one of the very few trading pits that still exist today, it is basically impossible to find an individual seller and negotiate a fair price on your own. Fortunately, today's trading is easier and more accessible than it has ever been. Using a computer or cell phone, you can direct a broker to make a trade on your behalf. You can give your broker specific instructions on how to execute your trade with different order types. Today, we are going to learn about the 5 different types of orders that you can use to buy or sell stocks and any other type of asset. If you learn how to use these orders properly, you can increase your profits and save valuable time. Before we get started, please take a few seconds to subscribe and click that like button for the YouTube algorithm. Alright, let's kick it off with the most basic and intuitive order type. This is called a market order. This one is simple because you are basically telling your broker, I want to buy or sell 100 shares of XYZ right now. Your broker will then execute your order at the best price currently available. These orders generally execute in less than 1 second, at or very close to the current share price. A market order is a good choice when you want to prioritize speed and be absolutely certain that the transaction will occur. You should be careful with market orders though, because it is possible that your order will get filled at a much higher or lower price than you expect. This is most likely to happen if the bid-ask spread is very wide, the asset is experiencing high volatility, or if you place the order before market hours. In any of these cases, you could place a market order to sell a stock when it is trading at $15 per share, but get your order filled at $14.75 due to a rapid drop in the price of a stock. Generally speaking, this is only something you really need to worry about if you are doing high frequency trading or trading in extremely high volatility conditions. The next order type that we're going to look at is my all-time favorite. I probably use limit orders for about 90% of the trades that I make. With a limit buy order, you tell your broker the highest price that you are willing to pay for a stock. That order then will remain open until the stock falls to or below your limit price, at which point your broker will execute the order. For example, say I am interested in purchasing shares of AMD, but it is currently trading at $55 per share, and I would prefer to get a better deal. So I might decide to put a limit buy order in at $50. I can then walk away from my computer and go about my day while my broker keeps a close eye on the market and watches for an opportunity to fill my order. Say 4 hours later, AMD briefly dips below $50. I may not be in front of my computer to see the opportunity, but my broker will execute the order, saving me time and potentially $5 per share. Limit orders work similarly when you are selling a stock. If I already own the shares of AMD, I could put a limit sell order at $60 in hopes of increasing my profits. Limit orders are very effective because you will never get filled at a worse price than you entered on your limit order. Occasionally, your broker may even manage to save you a few extra pennies by filling your order at a slightly better price. The downside about limit orders is that there is no guarantee that your order will get filled, in which case you may decide to cancel that order and enter a new one at a different price, or move on to a different trade entirely. The next order type that you should learn about is called the stop order, or sometimes referred to as a stop loss. Stop orders are commonly used defensively to minimize your losses, so let's look at the sell side of this order type first. Say I own the shares of AMD, currently trading at $55, but I don't want to be caught holding the bag if the stock plummets suddenly. I can submit a stop order at $53, so if the stock price starts dropping and crosses that $53 threshold, the stop order will then be converted into a market order and execute immediately at the best available price. This may not seem ideal because I would have been better off if I had just sold when the stock price was up at $55. But no one can predict the markets, and telling your broker to be ready to sell at $53 will minimize your losses if the stock continues to dive lower. Since a stop order triggers a market order, the same rules apply. You may get filled at a worse price if the stock moves rapidly through your stop threshold. Buying with a stop order works the same way. You might submit a stop buy order if you think a stock might break out towards the upside, but you want to wait until it starts to rally to confirm your prediction. In this case, AMD might be trading at $55, and you believe it has potential to rally up to $65. You could submit a stop order at $57 to potentially buy in after the upward move has begun. If the stock doesn't break out, your order will remain unfilled and you can avoid holding a stock that is not rallying. The next type of order is called a trailing stop and shares a lot of similarities to the stop order that we just learned about. Instead of setting a specific price for your stop order, you can set the order to follow or trail the current stock price by a specific dollar amount or a percentage. So if we take our example of AMD trading at $55 again and submit a trailing stop buy order $2 above the current share price, then if AMD moves up, a market order would be triggered at $57 per share, just like it did in the previous example. But if the price dropped to $51 before rallying, the trailing stop would lower our threshold to $53 and execute a market order if the stock then rallied above $53. The same concept applies if you are selling with a trailing stop. The threshold will follow the stock upwards in hopes of maximizing your gains before the stock changes directions. Markets tend to oscillate rapidly, so if you decide to trade with a trailing stop, be sure to make the margin by which the order trails large enough to not get triggered by the first routine market fluctuation. The last type of order that we're going to look at today combines both the stop and the limit order and is intuitively referred to as a stop limit order. This one can get a little tricky, so please stay with me here. You can use this order in a similar situation to when you might use a stop order. So if you were looking to buy a stock currently trading around $55 per share, but you want to wait for confirmation that the stock is establishing an upward trend, you can set your stop price at $57, just like we did in the previous example. But when the stock reaches $57, instead of triggering a market order, it will trigger a limit order. You can set this limit price below your stop price, let's say maybe at $56, in hopes of getting a slightly better deal on the stock if it has a slight pullback before continuing its rally. The sell side of this order looks like an exact mirror image. So say we own the stock and it's trading around $55. If the stock starts to trend downward, we want to get out of the position, but we also want to get the best price possible when selling our stock. We can set up our stop at $53 and our limit at $54. When the stock crosses our $53 threshold, our limit order at $54 will trigger and wait for the stock to bounce back to $54 before it executes. Now I want you to take notice that instead of having only one condition to meet before the order will execute, a stop limit order requires two separate conditions to be met in order for the trade to execute. That means that the probability of this order not being filled is much higher than with any other order type. But if they function as intended, your stop limit orders may be able to save you a bit more money than you would using a plain stop order. By default, all order types are canceled at the end of the trading day if they remain unfilled, but you can also instruct your broker to keep the order open indefinitely until you cancel it manually. This option is usually abbreviated as GTC, or good till canceled. If you decide to leave a limit order or a stop order open overnight, you should be aware that it is possible that the stock could gap up or down past your order price. This could cause your order to fill when the market opens on the next trading day at a drastically different price than you set. Gaps commonly occur when news breaks overnight or if a company reports earnings or announces a new product. So if you have open orders, it is good to be aware of any scheduled corporate announcements or watch for new headlines. If you suspect that a gap will occur, you can always cancel an order before the market opens and place it again once the volatility decreases. Okay, that was a lot of information to digest, so let's do a quick recap. There are 5 main types of orders, and you can use each of them to buy or sell a stock or any other asset. Market orders are effective if you want to prioritize speed with a 100% chance of execution. Limit orders are effective when you want maximum control over your transaction price. Stop orders are a good choice if you are uncertain of the direction the stock will move, and you want the transaction to occur after the stock starts to make a substantial move. A trailing stop order is a good tool if you want to maximize your gains while having an order ready to trigger if the stock makes a substantial change in direction. A stop limit order can be effective in very specific situations when you are looking for confirmation of a trend, but you also want to secure a slightly better price. I hope that this video has helped you develop a better understanding of order types and how to use them. If you are new to investing and this all seems too confusing, I would recommend that you start by learning and mastering how to use limit orders and market orders before you worry about any of the different types of stop orders. If you learned something today, please support my channel by subscribing and hitting that like button for the YouTube algorithm. If you have any questions, I'd be more than happy to answer them in the comments below. Last but not least, if you want to get started investing, you can get 2 free random stocks valued at up to $250 and $1,400 if you sign up with my WeBull link in the description below. Until next time, keep calm, stay healthy, and happy trading.